gold is cheap historically. I think the level now is about 16 to 1 or so, 16 ounces of gold to buy the Dow. I think, it's going much lower. I mean, certainly below 10, probably below 5. Whether it gets to 1 to 1, it's a tough call. Maybe 2 to 1. But even 2 to 1, where would that be? Well, gold would have to be 20,000 if the Dow is 40,000. But, we've been there. We've been at 1 to 1 almost twice in 1932 and even 1980. 1980, it was $800 for an ounce of gold and $800 for the Dow. So they were about 1 to 1, or they're approximately. Now, that represented a very cheap Dow and very expensive gold at that point in time, but it happened, right? So if it happens again, right, it doesn't mean that, gold should be that expensive or that the Dow should be that cheap, but it can happen.
Peter Schiff points out that the gold-to-Dow ratio has historically been low to almost 16:1 as it hit in the past, to 1:1 in 1932 and 1980, when both were priced around $800. Analysts predict it could drop below 10:1 if gold prices rise due to potential Fed rate cuts and global uncertainties. A 1-to-1 ratio could happen again, meaning both gold and the Dow could be priced at $40,000. If the Dow reaches $40,000 with a 2-to-1 ratio, gold could also hit $20,000 per ounce. The speaker, Peter Schiff, an American economist, financial commentator, and CEO of Euro-Pacific Capital, is known for his bearish views on the U.S. economy and the global economic system. He explains that the U.S. is facing enormous trade deficits, signs of a weak economy. In August 2024, the U.S. trade deficit dropped to $70.4 billion, an 11% reduction, mainly due to decreased imports and increased exports. While the deficits have slightly decreased from record highs, this is likely because Americans are too financially strained to keep buying. Mortgage rates continue to rise despite the Fed's rate cuts. These large trade deficits highlight the underlying economic struggles in the U.S. Peter Schiff is concerned that the Dow is still overvalued relative to gold, which remains cheap by historical standards. The speaker believes that while the Dow could rise in dollar terms, it could crash in gold if inflation soars. The critical point is that gold hasn't changed. Its rise reflects the dollar's decline in value. Since 1971, the U.S. has left the gold standard. Gold has gone from $35 to $2,600, showing how much the dollar has devalued. This trend could continue, with gold reaching even higher prices over time. If you enjoy the video, please give it a thumbs up and subscribe to stay updated on our latest content. Currently, only 11% of our viewers are subscribed. Help us reach our goal of 1,000 subscribers by hitting that subscribe button.
The trade deficits are enormous. We've had record trade deficits earlier this year. The fact that they're slightly below all-time record highs, I mean, it doesn't mean anything. The fact that we're running these massive trade deficits in and of itself is evidence of a weak economy. The fact that they're not quite as massive as they were a few months ago doesn't change anything. I mean, one of the reasons that the trade deficits may finally be coming down is Americans are just so broke that they can't buy any more stuff. I mean, they're maxed out their credit cards. Meanwhile, credit card interest rates just hit a new record high. They're still moving further above 21%. So the Fed rate cuts hasn't brought down credit card rates. They keep going up. Haven't brought down mortgage rates. They've been inching higher. So Americans are still struggling with rising interest rates, even though the Fed has cut them. But no, I think that the huge trade deficits reflect the underlying weakness of the U.S. economy. So gold is cheap, relative to the stock market, and so that's going to change, because the stock market should not be as richly valued as it is, given the enormity of the problems that are not being priced in. But that said, right, if we have hyperinflation or even extremely high double-digit inflation, then you would expect the Dow to price that in, but not in terms of gold. So I can be very bearish on the Dow and think that it's overpriced or overvalued, but that doesn't mean I don't think the price can go up in terms of dollars. It absolutely could go up. I mean, the Dow can go to 100,000, but if gold goes to 50,000 at the same time, the Dow has crashed, because now we're down to 2 to 1 from 16 to 1. So you have to look at both prices to know what the Dow is really doing, because you got to separate out the dollar, because the dollar has lost a lot of value. When the country started in 1789, you needed $20 to buy an ounce of gold. And even as late as 1933, before Roosevelt devalued, you could still get an ounce of gold for $20. That's like 150 years, and the dollar didn't lose any value. But starting in 1971, because gold was still $35 an ounce until 1970. But once Nixon took us off the gold standard, now you don't need 30. You can't buy an ounce of gold with $35. You need $2,600 to buy that ounce of gold. Now, what has changed since 1970? The gold hasn't changed. Gold is exactly the same, right? They haven't improved gold. Right? Gold is not like a car or a telephone, something that's gotten better, right, over time because we have better ways of making it. Gold has not changed. It's exactly the way it was 5,000 years ago when they were using gold. So gold has stayed exactly the same. What's changed is the value of the dollar. You used to be able to buy an ounce of gold for $20. Now you need $2,600 to buy the same ounce. So if gold can go from $20 to $2,600, it can go from $2,600 to $26,000 or $260,000. The only question is, how much longer is it going to take to get to those prices?
Peter Schiff highlights gold mining stocks have underperformed despite gold's significant rally this year. Major stocks like Barrick and Newmont hit multi-year lows earlier in the year due to analyst downgrades, assuming gold had peaked around $2,000. Investors are quick to sell mining stocks at any sign of a gold price dip, causing the stocks to lag behind gold's gains. Gold mining companies are also trading at discounts to the S&P, despite improving profitability with rising gold prices and low oil costs. Meanwhile, Peter Schiff exposes that there have been net outflows from gold mining ETFs like GDX and physical gold funds like GLD, indicating that the public and institutions have yet to participate fully in the rally. However, foreign central banks, such as Poland's, have been increasing their gold reserves, signaling the anticipation of a post-dollar world where gold plays a more prominent role. As central banks continue to buy gold to replace their US dollar reserves, the speaker suggests that gold and silver are still undervalued, presenting a great buying opportunity for physical metals. Let's recall the interview.
The mining stocks have barely outperformed gold year to date, and given how cheap they were, and if you recall, too, at the early in the year, in fact, I don't know if we talked about it on the last podcast, if it was before or after, or your last show, but February or March of this year, we had major downgrades of Barrick Gold, Newmont Mining. Both of those stocks were hitting multi-year lows. They didn't just hit 52-week lows. They hit multi-year lows earlier this year. So the mining stocks were very cheap, and then gold had this huge rally. And the mining stocks, didn't give you the type of returns, the type of leverage that you would have expected, given how cheap they were before we had this big rally. And that's because when gold was at 2,000, everybody assumed that that was the top and that it was just going to go down. And that was the basis by which they downgraded Newmont and Barrick, as the analysts didn't see any upside in gold. They thought gold had topped out. Little did they know this was going to be the best year since 1979 for the price of gold. And, if you watch these stocks, and I watch them pretty closely, investors are very skittish. There's very little conviction because at the first sign of trouble, you see a move down in gold and they just dump these gold mining stocks. They'll get crushed. And then it takes several days rallies for them to come back, to where they were. So gold can make a new high and the gold stocks, won't. And then it makes 2 or 3 new highs in a row. And then the gold stocks will finally catch up and make a new high. Then you get a small correction. Gold drops maybe 30, 40, 50 bucks, and gold stocks lose almost everything they gained. And so now, even when gold makes another new high, the gold stocks are still 5% below the previous new high because they haven't even come close to recovering what they just lost. And it looks like, too, like the gold mining stocks just trade as a proxy for the gold price that day. People are still not looking at them as actual businesses and thinking about how much their businesses have improved with the price of gold. When you got record low oil prices for gold miners, that's good for their profits. I think we're going to start to see some big beats in the mining companies. Meanwhile, the big mining stocks, Barrick, Newmont, are trading at discounts to the S&P when they historically trade at premiums. They're trading at very cheap price to book. I mean, these companies are making a lot of money. They're poised to increase their dividends, increase stock buybacks, and nobody owns them. In fact, if you look at the big gold mining ETFs like the GDX, GDXJ, they've had net outflows this year. Investors have been selling gold stocks, just like they've been selling physical gold. The GLD, the biggest gold ETF, has had net outflows this year. So the public is not involved at all in this rally, which goes to show you how much bigger the rally is going to be when they finally get involved. And not just the mom and pop retailers. It's going to be, the institutions, the big boys are going to come. I mean, right now it's foreign central banks, but they're going to step it up. They have a lot more gold to buy. They've barely scratched the surface. Look now, Poland just announced that they've got more gold now than the UK. But this is a race. I mean, these central banks need to replace their dollars with gold because they can read the writing on the wall, right? They wrote it. They know the dollar's days as the reserve currency are numbered, and they have to prepare for a post dollar world. And that's a world where gold plays a much more important role as a monetary reserve. And so that's why these central banks are buying. And they've got a lot more fiat to convert to gold, particularly U.S. dollars. So I think this is a great opportunity. I mean, people should be buying the physical metal. Gold and silver are still very cheap. Silver is barely above $30 an ounce. It was $50 in 1980. There's not that many commodities that you could buy, for 40% off their 1980 price. So silver is one of them. So people should be buying it.
The rising price of gold reflects the depreciation of global currencies, especially the dollar, as inflation and economic weaknesses become more evident. While gold mining stocks have underperformed despite gold's rally, the fundamentals remain strong, with central banks increasing their gold reserves in preparation for a post-dollar world. There is a compelling opportunity for investors to consider gold and silver, which are still undervalued relative to their historical prices and economic conditions. How do you think central bank gold purchases will impact the long-term value of gold and silver? What factors could finally drive mining stocks to outperform gold in the future? Let us know in the comments section below. Also, ensure you like this video, subscribe to the channel first, watch the video, and turn on post notifications for more videos like this. Until next time.